Hello, this is Jeff Bish, president of MarketGauge.com, and I'm filling in for Keith for this week's Market Outlook video. And this week's going to be a little different in that I am introducing our new and improved version of Little Big View, so I can show you some of the ways you can track some of the stuff that I'm just talking about in the commentary this week, and you'll be able to do it each day, not just hear about it at the end of the week in this video. So we're pretty excited about that. But before I get to that, let's take a look at the markets from the big picture as we usually do. And I think that the key thing to be focused on going into December is, first of all, December really can do anything. And it's typically a very bullish month of the year. And as much as I've pointed out in the commentary, and I'm going to point out some warning signs here in the video, warning signs primarily that focus on the fact that the market is a little extended in terms of its price action in a lot of areas, and in terms of its market internals or its breadth, it's not on board with the extension in price. And we'll see what that means in a minute. But at the end of the day, we need to focus on the price action. So let's start with the price action in the 4 Market Watch charts. I'm going to start with the IWMs because the IWMs really are the problem here to watch out for. And if we look at the IWM daily chart, scrunched up really tells the picture. The range that I have drawn here in, and I'll highlight it in white here. So this range right across here, which is what IWMs are struggling with right now, is a really significant top end of the range. I see these two highs up here as kind of the extended top of the range. And while we may not seem to be worried about it right now, this is probably the bottom of the range. And so I look at this and say, if the IWMs can break out and move higher, everything's in gear in the market. But if the IWMs continue to be stuck in this range, it's indicative of a broader market which is not participating enough to get overly excited about a move higher. That said, December, we want to follow the momentum in the right groups and in the right stocks, but we need to understand the risks. And the IWM chart really, I think, exemplifies the risk and is a good way to keep track of it. Now, Friday, the breakdown from the attempt to break out here is really disappointing. The Qs are just bulletproof, as we'll see in a minute. The Qs continued higher, so it remains to be seen whether or not this just happened to be a weekday, which we've seen before. And on a shorter term basis, I would describe the IWMs really as being stuck in this range. So if the IWMs pull back down and hold the 114 level, all is okay as long as the other indexes are holding up better. On the other hand, if IWMs break out, that's what we're really looking for if you're the bull. So keep your eye on the IWMs and how they respond to this key 118 level. Now let's go to the Spies, because the Spies really sit right in the middle, and the Spies can pretty much suffice for the Dow as well. And the interesting thing about the Spies here is they spent all week, for all intents and purposes, in the last Friday's range. So I would look at this, again, focusing on price action, forgetting about the indicators for a second, and follow this in whichever direction it goes. Now, follow it to the downside for me means I'm going to be really cautious as a bull if we break down below that range. Also represents breaking below the 10. So real confirmation below that 10-day moving average, which is the green, and below this range would be worrisome for me as a result of all the other metrics that we're going to look at in terms of the market internals. So Spies, follow that range, and then we get to the Qs in just one second. Get to the Qs. which I described a minute ago as just seeming to be bulletproof. You can see they just have been on an absolute tear. And I'll point out that we did point out that here's the breakout kind of above this level. IBM, the SPIs are a little bit more extended than the Qs were at this point, but the range that the SPIs have been put themselves in the last week creates this same environment. So if the SPIs break out to the upside, we could see a move somewhat similar to the Qs. Like I said, it's December. I would not at all be surprised if this market melts up, but let's be clear. The market, the Qs in this scenario here are essentially melting up, and melt-ups don't last forever. And that's where the concern for risk has to come in. All right, now, the other thing, or let's say the first thing that really makes me a little nervous about the way the markets are going up, aside from the fact that the IWM is not following it, is the strength in the TLT, or the weakness in rates. Rates are going down, bonds are going up. That's the way the relationship works. And this whole pattern right here, the explosive move to the upside, which corresponded, as we all know, with the panic low in the stocks, has had a very constructive, rounded type bottom. Now, usually you look for these at lows, not at highs, but the way that it sits right on this 50-day, the way that the 50-day has held this market up for so long, all year, essentially, and now it's just propelling out of here. Now, I realize that there was news that Draghi is, talking about more stimulative actions. So I realize this is news driven, but that doesn't matter. The market is set up in a way that it's already started to launch. 123 to 124. I have 123.5 here. I think that's a significant inflection point. Is a really significant level going back. Let's take a look. And if it gets to that point, I would expect to see some volatility. If it breaks through that point in any significant way, I find it would be hard to believe that wouldn't indicate that there's enough fear in the market to put a lid on stocks. So while I don't have the fundamental case to make for it, the technical case that I would be concerned about is that the strength in the TLT is indicative of more fear than stocks are currently showing. And that fear in stocks, as we all know, can show up very quickly. And TLTs could be the warning sign that that's happening. So keep an eye on TLTs, especially if they get up to the 123.50 level. Pay attention to them, extra attention up at that level. So while I'm on the topic of fear, let's take a quick look at some of the metrics that we tend to look at each week. First of which is VIX. Now, VIX is going to show up later when we look at Little Big View, but the metric that we are accustomed to looking at, or at least the way that I present it when I do the videos, is to look at the actual cash index, and we look at the Bollinger Bands around that index. Well, it's been a long time since this has happened, but VIX touched the bottom end of the Bollinger Band. And typically that is indicative of just too much to the downside on VIX, and a move up in VIX, again, is usually indicative of fear moving higher. So this happening essentially at all-time highs is exactly where you would start to think or start to look at the market as being just too complacent. Again, we're waiting for the price action. We'd like to see the SPIs break down through the consolidation before it's confirmed, before that confirms this VIX reading. But when the VIX hits the bottom of that Bollinger Band and then comes back through it, it's a red flag. So I raise the red flag. Now, we're also looking at McClellan. We always look at it as a broad measure of overbought or oversold. It's sitting right in the middle. So McClellan right now is not indicating an overbought reading, but it's certainly not indicating oversold. To me, I would just chalk McClellan up to neither supportive or negative in terms of which way the market might go. All right, so I want to spend some time looking at the different indexes or the different ETFs that are leading the market. But before we do that, let's take a look at the new and improved little big view. And I'll just give you a quick tour around it so that you can use this during the week, and also so that I can show you some of the new high, new low concerns that I raised in the commentary leading up to this video. So first of all, you'll find Little Big View on our site under the Resources tab. All you have to do is mouse over Resources and you'll find Little Big View right here. Little Big View, the name really just indicates a quick glance at the big picture. And that's exactly what this is intended to do. So the market overview section, I'll go through this relatively quickly since you can come back and get this for free anytime you want. Market overview section is intended to let you know how the major indexes are doing over a couple of different time frames. And I think the real gem here in this section is this accumulation distribution tracking right here. So accumulation distribution is simply if the market goes up on more volume than the prior day, it's accumulation. If it goes down on more volume than the prior day, it's distribution. If you don't have more volume than the prior day, then you don't get either accumulation or distribution. Now, this is something that IBD has tracked for a while, and it is pretty effective if you just limit it to looking for 4 or 5 days of accumulation or distribution over a 2-week period. If you just use that as a confirmation that either there might be trouble or a confirmation that the market has some strength behind it, it serves as a really good heads up. And with that said, it's noteworthy that right now we have a situation where we've got the SPY with 4 distribution days. So that's exactly what you don't want to see. Now, the diamonds are not at all participating in this negative action, and the Qs really aren't either. So it's not like raising a huge red flag and saying we've got huge distribution at the highs, but this is a really easy way to keep track of it. And as you can see, it might be time to start paying attention to it, especially if the markets do have a down day. You might want to come here and see if it was a distribution day. So in sector summary, we give you the ability to look at some of the major ETFs that track industry groups or sectors within the market. And this is a really easy way to see which are leading and whether or not they're leading with really good price action. So if you look at the markets right now, you can see that underneath the markets, we've got sectors that have been strong over 3 months and 6 months. If the market starts to level out, even roll over, you'll start to see some red creeping up in here, and it'll give you a heads up on which sectors to focus on. And so we're going to come back later in this video and look at some of these sectors. The leading sectors I'll pull right off of here, and that's exactly what this is intended to do. In terms of the phase, I'm not going to cover the phase in this particular session, but we'll cover that in other videos. Now, market hotspots section is an area where you can see what's going on today. So what was hot and what was not today. And what we do is we take it's a scan of a much larger universe of ETFs than just domestic sectors. So you can see what has moved today. And I'm going to point out some interesting patterns to look for and that also showed up today. First of all, or Friday. first of all, here's VIX, and this literally had me do exactly what I explained to you just a few minutes ago. I saw that and noticed, Friday the markets were up, and VIX is not something you'd expect to be up in an up day in the market. So this was a heads up to me that I better go check out that volatility band, and sure enough, it is at the warning sign. So VIX popping is a perfect example of what you might find if you keep an eye on this, i.e. something that you weren't quite expecting. The other thing that's interesting about this pattern, this particular day, and this is something I look for all the time, which is you'll notice that the areas that were hot today, the areas that were up today or Friday, are also areas that are just following their major trend. All right, so now in the case of VIX, it stood out. It was the only one that wasn't. The areas that were down, all right, now these are going to be the areas that are down the most for the day, have been the areas that are down. So that, in other words, the leaders are continuing to lead to the upside, and the dogs are continuing to fall to the downside. This will not always be the case, and when it's not the case, it can cause you to find some interesting scenarios, well, similar to what I just pointed out in the VIX. Now, let me scroll down. On the bottom of the page, you'll see not just what's hot today, but you'll see what's hot over 6 months. Okay, and it's interesting to see that the pattern pretty much follows on the 6-month pattern as well, which is this particular table is ranked by the stuff that's up the most in the last 6 months, but you'll see they were all up. Now, biotech was down marginally, but if you go look at the chart, you'll see it actually had a pretty positive day and just sold off as part of the market did. But more or less, strong days from the strong areas of the market, and the biggest losing areas of the market are also biggest losing areas over the longer periods. Again, this is not always going to be the case, but it's a pattern to watch out for, and this is a page that makes it really easy to find these kinds of patterns and situations. And then finally, we've got the market internal section. Now, this is a pretty slimmed down view of market breadth. It doesn't have everything. It doesn't have the McClellan oscillator, which we would like to have here, but currently don't. But it does have the advanced declines and the new high, new low ratio, which I don't know where else you can find this particular ratio. And I think it's one of the best indicators, best single indicators you can use on the longer term health of the market. And while it doesn't show you exactly the numbers I was talking about in the commentary leading up to it, leading up to this video, it does illustrate a very similar metric, which is how many, if you take the total number of stocks making new highs and new lows, what percentage of that are making new highs? And you want to see, and you can see this in the chart itself, you want to see that number be over 70% to be bullish. And if you're really over, if you're really over 85%, then that's really bullish. So up around 80 isn't so bad. But where it becomes problematic is where you come up and then roll over. Okay. The other thing you want to look at is the trend of it. So as I said in the commentary leading up to this, you want to make sure the market continues to move higher. We want to make sure that this number stays above the 70 mark. And regardless of whether the market moves higher or not, we want it to stay above the 70 mark. If it falls below the 70 mark, it is definitely a big warning sign. And of course, then you're also going to want to see what the price action is doing in the other underlying index if you're breaking major levels. And this is breaking the 70 and pointed down. It's a dangerous situation. So you can see looking back when it peaked out and started to fall, it was already kind of in a fall when the market started to fall here, and it was broke down even before the market started to fall the second time. And then from a bullish point of view, we haven't seen a lot of this, but we did see it in October. If you can get down below 20, it means you've really washed out the markets. Now, this is not necessarily the time you want to be a buyer. You want to see it turn back up, which it did. And once it did, it lines up. Not with the low. You're never going to catch, well, I shouldn't say never, but you're not likely to catch the low in the market unless you have multiple lows and double bottoms. But this in a quick sell-off situation is a good confirmation coming back above the 30 that the strength of the market could be back. And again, from there you follow the slope. So this is, as I said, one of my favorite indicators. You should be able to get it right here for free in Little Big View each day. We will ask you to log in, but that's just so we can see the level of usage in the particular area, but it will be free. So with that, again, all you have to do is go to the resources area and Little Big View, and you'll find it. So just to wrap up, let's take a look at the different areas of the market with respect to the different sectors and ETFs. Let me pull it in here. All right. So essentially what I'm going to do is look at some of the different sectors that you could find on Little Big View and sectors that you can find when you follow sectors through the ETFs and be able to see the leadership in the market. Now, the leading sectors right now, one of them, SMH. So we'll take a look at SMHs. And when I say the market's extended, I'm looking at extended based on how far are you from the 50, from the 10, and the 200. Now, clearly, SMH is on a tear, broke out from a nice consolidation and has just roared higher. Again, it's hard to pick a top, and I don't like to pick a top, so I'm not going to try. Just know that it's risky. I also can see that this particular trend is in great shape, even if it pulls back. In fact, if it were to pull back to the 53 level, it would still look good. Even if it pulls back to the 52 level, it would still look good. Now that means that the market could pull back pretty substantially in terms of this particular leading index, but as long as the leading index certainly stays above 10, or the 10-day moving average, it's a good indication that it's still in good shape. It's just a little extended from the 10-day, so we want to be wary of that. The other ETF that has been a pretty strong market leader, but hasn't quite exploded higher yet, it's kind of worked its way higher, is the healthcare area. So this is another area to take a look at. And again, if the market pulls back, focus on whether or not it holds up nicely around the 68 level where it broke out from. Retail also has been quite strong, and this particular sector has really had a nice breakout above this 89. And so if we look at this consolidation here and we look at a breakout, if we call it from 89 up to 94, it's not completely extended on that basis, but all at once, perhaps it is. And if it pulls back, this again is another one I look for, another opportunity to get in on a pullback, assuming, of course, that the overall market's health doesn't fall apart and the other leaders stay as leaders. So XRT is interesting. Now, the other one that let's take a look at is the transportation, IYT. Now, this is one I think you should pay particular attention to. Oil was the reason for the markets to gap higher on Friday. This clearly, transportation would be a huge beneficiary of lower oil prices, and certainly that seems to be the trend. But this price action is not what you want to see. So a big gap higher, and even though oil continued to move lower, oil closed 10% lower, this particular index, according to this, closed marginally higher, but closes on the low of the day. If this continues to break down from here, this is a very toppy looking formation. This has had a really nice run. For all intents and purposes, it could probably pull back substantially down to the 156 area and still be okay, but a breakdown of that magnitude definitely be something we'd want to watch and view as more than just a short pullback. I have to look at it as a correction and make sure that, again, the market internals remain constructive if we get a pullback of that nature. Now, I'm not looking to predict that this is the top and we're coming back to 155, but my point here is looking at the sectors, this looks a lot different than the other stronger sectors out there, and the news that drives this higher really should have had this closing on the highs, not closing on the lows. Other thing along those lines, XLU has been consolidating, closed on its highs. Now this is perhaps consistent with the TLTs and interest rates moving lower. But again, that's not necessarily bullish for the market, but it could be bullish for this particular ETF. And so notice this ETF was an ETF that people supported when October hit. It took its hit in October, but not nearly the same as the rest of the market. And it was one of the first after the hit in October to really take off and run. The whole thing still looks very positive. The pattern here looks very positive. I don't know if that's good for the overall market or not. I would tend to say not, but it is good for your portfolio to know that this could be a place to go to find a trend that's working even if the market starts to pause. All right, and finally, the heads up on the VIX, which we had in the market hotspots. If you look at this chart, VIX, the trading ETF is at a really interesting area to look for a bottom, as we pointed out in terms of the hash index, topped out, or I shouldn't say topped out, bottomed out near the Bollinger Band on Friday too. Now this index, you have to warn you, it can be quite volatile, and one day's action doesn't make a trend, but definitely something to keep an eye on going into this week, and a good way to potentially hedge if you think that the market could be getting toppy here. So I'll leave you with that, and I hope this has been helpful. As always, don't forget to subscribe to our YouTube channel if this is where you're seeing it, and send us any feedback that you might have, and best wishes for your trading and best wishes for the end of the year. Thank you very much. I'll see you in the next video.